In this session, we are going to be looking at foreign currency transactions. This essentially covers two chapters, chapter 20 and 22, where we look at foreign currency transactions, as well as the hedging relationship that is prevalent within foreign currency transactions as well. When looking at the scope, it's very important that you always follow with your lecture guide. So your lecture guide is available on Moodle, and that's going to tell you exactly which sections are examinable for the particular chapters. So for chapter 20, there's a couple of exclusions, as well as for chapter 22. So make sure that you do go through this as you follow in your textbook, to make sure that you don't go over unnecessary sections when performing your studies. So firstly, we start off trying to understand why we're even looking at foreign currency transactions. The currencies trade every day, and therefore the value of foreign currency fluctuates constantly. As you will see on the JSE, as well as on the stock exchange, they do show you the exchange rates and how they are constantly changing throughout the day. Any transaction can occur in a foreign currency, but our books and financial statements are in another currency. So then how would we account for this type of transaction when it happens? So if we're using the Rand, but we have now engaged in a transaction in euros, so what are we going to do in that case? How are we going to account for this transaction in our financial statements? Also, how do we account for the fact the value fluctuates constantly? So will we record it today? Will we record it tomorrow? What date do we use to actually do the translation from foreign currency to our own functional currency? Is there a way we can protect the company from the constant fluctuation of currencies in the markets? The answer to this lies within hedging and forward exchange contracts, where we can lock in a certain exchange rate and protect ourselves essentially from these constant fluctuations. For the purposes of these slides, the abbreviation FC will refer to foreign currency and LC refers to local currency. When looking at monetary versus non-monetary, what do these two concepts really mean? So monetary means that there's a right to receive or an obligation to deliver a fixed or determinable number of units of a particular currency. Whereas what is non-monetary? This is an item that is neither a right to receive nor an obligation to deliver a fixed or determinable number of units of currency. Some of the examples that you are already familiar with include PPE, intangible assets, inventory, and prepaid expenses. So all these items are considered non-monetary, whereas monetary really refers to some form of cash. Looking at exchange rate, so there are two ways in which you can be provided with your exchange rate. The first is the direct method. So how many of the local currency do you need to purchase one of the foreign currency? So if the foreign currency is denominated in 1, we'll need 5 of the local currency to purchase 1 of the foreign currency. Okay. Then the indirect way in terms of presenting an exchange rate is how many foreign currency will one local currency purchase. Okay. So one local currency will give us 0.2 of foreign currency. Okay, so it really is the same as the above. It's just with what is the actual base. So which one are we denominating as 1? And that will affect what the other will then be presented as. Remember that your exchange rates are in fact quoted daily. So every single day, these are going to change. And any rate that is determined on a particular day is referred to as the spot rate for that day. We're now going to look at our first example from the Grip and Garb textbook. In this example, you are quoted a spot exchange rate on the 1st of March 20X1 of $2 to £1. You're firstly required to, if we had £1,000 to exchange, how many dollars would we receive? So if 1 pound gives us $2, how much would 1,000 pounds give us? It would give us $2,000, as you see in our solution. The second scenario, or scenario B, says if we had $1,000 to exchange, how many pounds would we receive? So we know that $2 gives us 1 pound. So how much pounds would we get for $1,000? So $1,000 divided by $2 times by 1 pound means we'll get 500 pounds. This third requirement is to restate the exchange rate in the format of $1 is to how many pounds? Okay, so how are we going to get $2 to $1? What do we need to do to that side of the exchange rate equation? So $2 divided by 2 will give us $1. We then need to do the same to the other side of the equation. So 1 pound divided by 2 means 0.5 pounds. So there in our slides shows you what the exchange rate would be if you changed what is going to be the single denomination. Some of the important dates we come across when dealing with foreign currency transaction is firstly the transaction date. Now, this would generally be the first date at which you will be recording a foreign currency transaction. This is when it is initially recognized and brought in the form of a journal entry. So what is very important when determining when is our transaction date will be dependent on the shipping terms. So definitely, how are they going to be shipping the particular non-monetary item? It could be inventory, it could be PPE. So are they using FOB? Are they using DAT? This is all going to impact when the transfer of risks and rewards takes place. When risks and rewards takes place in terms of the transfer, that triggers our transaction date, being our first date we're going to recognize the foreign currency transaction. We also have the settlement date. The settlement date is when cash in fact changes hands. So we're either receiving money or paying money depending on whether we are importing or exporting. Also, our reporting date or financial year end is going to impact in terms of our translation for any foreign creditor or any forward exchange contract. And so these three dates are going to be vital in what we're looking for in each of our questions. We're now going to work through an example. Example 2 tells us that Home Limited purchased bicycles from Faraway Limited, a manufacturer located in Iceland. We're then given a number of different dates. So on the 13th of Jan X4, we faxed the order for 1,000 bicycles to Faraway. Does that generate a transfer in risks and rewards? No, not yet. On the 16th of Jan, there's confirmation of acceptance of order. Does that give rise to a transfer of risks and rewards? No, not yet. On the 1st of February X4, it's loaded onto the ship in Iceland. Could this give rise to a transfer of risks and rewards? Well, it could, but depending on the shipping terms that the order has been sent via. On the 4th of Feb X4, the ship set sail. Then on the 31st of March X4, the ship arrived in Holmes Country Harbour and the goods are offloaded. Okay, so here might be relevant depending on the shipping terms that will then affect the risks and rewards and hence the transaction date. The 5th of April X4, goods arrived at Holmes warehouse, and then on the 30th of April X4, we then have our settlement date where Home paid Faraway. The 28th of Feb is Home's financial year end, so we do need to make sure that we take that into account when looking at our timeline. We then need to look at two different shipping terms in terms of this question. So where the item has been shipped FOB, so free on board, that then means on the 1st of February X4, once those goods are loaded onto the ship in Iceland, we then have our transaction date. Okay, so our transaction date, risks and rewards pass on the 1st of Feb 20X4. We have year end at the 28th of Feb X4, and then finally settlement on the 30th of April. If shipping takes place using the DAT term, so that is when they arrive at the destination point. And we then know that on the 31st of March, that is when the ship arrived at the harbour. So the 31st of March will be, in fact, the transaction date where the shipping terms are DAT. We then also need to account for year-end and settlement date, which is exactly the same as the FOB shipping terms. The only difference here is in relation to the transaction date itself. So when are those risks and rewards passing from the supplier to us? Looking at initial measurement, so we know that this transaction is initially going to be recognized on the transaction date, and that transaction date being dependent on shipping terms and when risks and rewards pass to the entity itself. What type of journal entries do you expect to process? So it would be the same as when you are recognizing the transaction within the local currency. The only difference here with the foreign currency transaction is that that amount needs to be translated into the local currency. So when you're doing that translation, you will be using the spot rate on the transaction date itself. So you'll use the foreign currency amount multiplied by the spot rate on the transaction date itself. When looking at the subsequent measurement of the monetary item, now what do we mean when we're talking about the monetary item within the context of a foreign currency transaction? The monetary item could be the forward exchange contract. It could also be the foreign creditor. And so you translate to the latest exchange rates on the end of each financial year. And so each reporting period, you would update that monetary item. It could be the foreign loan, it could be the foreign creditor. That is always going to be updated in terms of the spot rate on the date of financial year end, as well as at settlement date. So your foreign creditor is not going to be happy with you if you just pay them the amount that you would have paid, say, on transaction date or at year end. They need you to update their balance to your local currency, and then you must settle them thereafter. So it's very important that you draw timelines. It's a very useful tool to actually see when these dates are taking place, what changes have taken place, and how that ultimately impacts your journal entries. Remember your important dates. What should we be drawing on this timeline? We should be showing the transaction date, any financial year end, as well as the settlement date. You would also then want to find the exchange rates for those important dates, and you could insert those on your timeline. Also, what is important is, are you importing or exporting? Ultimately, that will differ in terms of whether you've made a gain or a loss as a result of the fluctuations in the exchange rate. So you do need to always ensure that you know from whose perspective you are preparing the timeline and the journal entries. An example of a timeline, so where it is settled before the reporting date, we would only basically be recording the exchange rate difference between the transaction date and the settlement date. If the reporting date is sometime after the settlement date, there's not going to be any exchange difference because we've already settled that monetary item or that foreign creditor. If it's settled on the same day, we're not going to have any exchange rate difference because simply transaction date and settlement date is the same date, and there's not going to be any difference that needs to be accounted for. If it's settled after reporting date, which is typically what you will see in your tutorials and tests and exams, you're actually going to have two pockets of exchange rate difference that needs to be accounted for. So between the transaction date and the year end, and then again between the reporting date and the settlement date. Okay, so as you can see, these timelines are actually very useful tools to be able to help us to determine what type of exchange rate differences we should be recording, when we should be recording them, and which exchange rates will we then be using for which dates. Okay, import versus export. Okay, so if in fact we are importing, we know that it's coming from a foreign country to our local country. So we are buying and will have to pay using that foreign currency itself. Okay, so if we're buying something and we owe them money, we therefore will have a creditor that will be raising. So as we import an item, we'll debit the assets, say inventory or PPE, and we would credit our foreign creditor. We owe them money, we have a liability. In terms of our exchange rate differences, we've got two examples for you here to show you how they will differ. So where you have perhaps a gain, so you've actually gained as a result of the change in the exchange rates, you would debit the foreign creditor because you'll actually be physically paying them less money, and you'll credit your foreign exchange gain. An example of this would be perhaps where your foreign currency was 4-1 and now it's been reduced. So the foreign currency is 3-1. So it ultimately means you're going to be paying less, and therefore you need to decrease your creditor by debiting them. Okay, and that foreign exchange gain would be a form of income. Now the contra would be true where you are experiencing a loss as a result of the foreign exchange. So where you would debit your foreign exchange loss in the form of an expense, and you need to credit your creditor because in essence, you're actually going to have to pay them more of the local currency. An example would be, say the local currency was 4-1, and now in fact it is 5-1. So you're going to have to pay more in your local currency to actually settle your creditor or your creditor supplier. So you have to pay them more, and therefore you'll have to increase the creditor itself. Now the contra is going to be true for when you're exporting, because now what's happening is it is going from the local country to the foreign country itself. So here we're selling, and we're actually going to receive a foreign currency amount. So if we are going to receive money or we're owed money, we're providing a good, we're exporting something, and they're going to pay us in the future. So we will have a debtor. How are these exchange differences going to be accounted for? Well, if we have a foreign exchange gain, so we would debit our debtor because they're actually going to be paying us more in our local currency, and credit our foreign exchange gain. An example of this would be where your foreign currency is 4-1, and then it actually results in a change in the exchange rate where the foreign currency is 5-1. Therefore, we are going to receive more money in our local currency, and we are going to therefore increase our debtor by debiting them. Where we have experiencing a foreign exchange loss, we're going to debit the foreign exchange loss being an expense, and we're going to credit our debtor. And this is going to be a case where the foreign currency went from 4-1 to 3-1. So we're actually going to be receiving less money, and therefore we can decrease the debtor. As you can see, this is the exact opposite for the changes in exchange rates above. And that's why it's going to be vitally important that you're able to determine, are you in fact importing or exporting? Because that's going to impact whether you would have a gain or a loss, dependent on the change in the exchange rates. We're now going to look at a series of examples, starting with example 3 from your Grip and Garp textbook. In this example, a sale transaction on the 31st of Jan gave rise to a foreign debtor of 2,000 foreign currency. So for the purposes of this example, let's say it's $2,000. So a sale transaction on the 31st of January gave rise to a foreign debtor of $2,000. The exchange rates of dollars to rands are as follows. They give you the 31st of Jan, 28th of Feb, and the 31st of March. They ask you to firstly calculate the debtor balance in local currency at the end of each month. Okay, so we would use these exchange rates to translate that $2,000 into local currency. So for the end of Jan, our local currency is 4. So we'll take the $2,000 times by 4 Rand to get 8,000 Rand. Same with the 28th of Feb. That foreign currency of $2,000 is still the same. The only thing that changed now is the exchange rate. So it's now 7 Rand to $1. So $2,000 times 7 Rand gives us 14,000 Rand. On the 31st of March, we now have $2,000. We multiply it by the 6 Rand, being our new updated spot rate on that date, to give us 12,000 Rand. The next requirement is to calculate the exchange differences between each of the 3 months. Okay, so we can see between January and February, we went from 8,000 to 14,000, so it went up by 6,000 Rand. Between February and March, it went down by 2,000 Rand. So overall, there was a net gain of 4,000 Rand. Okay, that is the gain of 6,000 Rand between Jan and Feb. And then the loss that was experienced of 2,000 Rand between Feb and March gives us the overall net gain of 4,000. We then prepare the journal entries for each month. Okay, so the 31st of Jan, we debit our foreign debtor with 8,000 Rand. How did they get that? What have we recognized this debtor at in part A at 31st of Jan? We're recognizing it at the spot rate of 8,000 Rand. We're bringing it into the books at 8,000 Rand, credit the sales because we have made a sale to a foreign customer. At the end of Feb, we're translating our foreign debtor. We said really at the end of Feb, now instead of paying us 8,000 Rand, they're actually going to pay us 14,000 Rand. So we have certainly made a gain between January and Feb. So we debited our foreign debtor by 6,000 Rand, the additional 6,000 Rand that they would have to pay us if they settled on the 28th of Feb, and then credit our foreign exchange gain. We then said between February and March, we in fact lost a bit of ground and we lost 2,000 Rand. Okay, so we need to account for that foreign exchange loss at the end of March, debit foreign exchange loss 2,000 and credit our foreign debtor with 2,000. We now move on to example 4 of the Grip and Guard textbook. And this example says to us that on the 5th of March 20X1, being the transaction date, company in Botswana, whose currency is called the Pula, purchased inventory for £100 from a company in the UK, whose currency is the pound. The purchase price was paid on the same day, and the spot rate was 3 Pula to £1. You're required to prepare the journal entries in the books of Botswana. Okay, so Botswana is the one that is purchasing inventory. Okay, so they're buying from somebody else. Okay, so what are they doing? They're buying inventory, so debit inventory with 300. How did they get 300? Was £100. We translate that to Pula by timesing by the 3 Pula spot rate to give us 300 Pula. So debit inventory with 300 Pula, credit bank with 300 Pula. When looking at example 5 from your Grip and Guard textbook, it tells us that a company in the UK sold inventory for 1,200 Pula to a company in Botswana on the 17th of May 20X5. The transaction date. Sale proceeds was received on the same day when the spot rate was 4 Pula to £1. The cost of inventory to the UK company was £150. You're required to prepare the journal entries in the books of the UK company. So the UK company were the ones that in fact sold inventory to the company in Botswana. So they made the sale. So we need to record the sale of that inventory. So our inventory was sold for 1,200 Pula, but we are dealing with the books from the UK. So we must translate that into pounds. So 1,200 divided by 4 gives us £300. How do we record the sale? We debit bank with £300 and we credit sales with £300. Okay, we then need to account also with every sale. We know that we are 2 legs to the transaction. The first one being for the selling price, which we recorded in the first journal entry. And then we have a second journal entry for every sale, and that is to record the cost price of the transaction. So in terms of this information that we were given in the question, the cost of the inventory was £150. How do we record the cost price leg of the transaction? We debit cost of sales and we credit our inventory. Example 6 gives us information about a company in Botswana that purchased inventory for £100 from a company in the UK on the 5th of March 20X1 being the transaction date. The purchase price was paid on the 5th of April 20X1. We're then given the dates for both the transaction date as well as the settlement date. We are required to prepare the journal entries for Botswana for the year ended 30th of April 20X1. Okay, so here we immediately can see that Botswana purchased inventory. So they bought inventory from a company in the UK. So that's whose perspective we are using when preparing our journal entries. Okay, so they purchased inventory for £100, but we're in Botswana, so we're working with Pula. On the date of the transaction, we know that the inventory cost us £100, so we need to account for that using the transaction date exchange rate, which is 3 Pula to £1. That means we'll recognize our inventory at 300 Pula. We debit our inventory with 300 and we credit our foreign creditor with 300. Why are we crediting foreign creditor here and not bank as we did in the previous examples? Because we're only going to make payment in April. Okay, so at the date of transaction on the 5th of March, we in fact still owe the company in the UK. So now when it reaches the 5th of April, we must now re-update. Okay, so we need to restate, we need to update our foreign creditor in the UK. Because are they going to be happy if we pay them 300 Pula on the 5th of April? No, they're not going to be happy because on the 5th of April, if we pay them 300 Pula, it's not going to equate to £100. Okay, so they want their £100, no matter how much Pula that is going to be. So on the 5th of April 20X1, before we can simply make payment, we need to update our monetary item. What is our monetary item? Our foreign creditor. Okay, so updating our foreign creditor. Now, if we were to settle them on the 5th of April, how much would we have to pay in Pula to pay the UK company £100? So on the 5th of April, we would have to pay 400 Pula to equate to £100. But how much did we raise the foreign creditor at? We raised it at 300 Pula. So we're going to have to increase our foreign creditor by an additional 100 Pula. How are we going to do that? We credit our foreign creditor with 100 Pula and we debit our foreign exchange loss. So we've made a loss because in fact the exchange rate has deteriorated over time and now we have to pay more Pula to get to the same £100 that our UK company is expecting. So now that we've updated our foreign creditor, it's now sitting at the correct balance at 5th of April at 400 Pula. We now can settle the foreign creditor by debiting the creditor because we no longer have a liability and credit bank to reflect the payment and outflows of economic benefits. We then look at question 7 from our Grip and Gop textbook. In this question, it tells us that a company in the UK sold inventory for 1,200 Pula to a company in Botswana on the 17th of May 20X5 being the transaction date. The inventory was paid for on the 13th of June 20X5. The inventory cost the UK company £150 and the year end of the UK company is the 30th of September. The exchange rates are as follows. We're given the exchange rate for the transaction date being the 17th of May, and then we're given the exchange rate for the settlement date, which is the 13th of June. We are required to prepare the journal entries in the books of the UK company. So the UK company was the one that was in fact making the sale. So we firstly want to record the sale that they've made. keeping in mind that we would credit our sales because we've made the sale and risks and rewards have transferred on transaction date. And would we debit bank? No, we wouldn't be able to debit bank because they're only paying us on the 13th of June. So on the 17th of May, 20X5, we would credit our sales with £300 and we would debit our foreign debtor with £300. And remember, whenever we record a sale, there must be two legs to the transaction. We've dealt with the selling price. We also need to deal with the cost price associated with that sale. They told us the inventory cost £150. So we can debit cost of sales, credit inventory with that £150. We then reach settlement date and we see that the spot rate has in fact changed. So what we need to do at settlement date is firstly restate or update the foreign debtor to the new balance. Okay, so we need to update the foreign debtor. So on the 13th of June, we now find that the foreign debtor would need to pay us how much? So they would need to pay us 1,200 divided by 3. They would have to pay us now $400 pounds. But how much did we raise the foreign debtor at transaction day? We raised it at £300. So they actually need to pay us an additional £100. How are we going to account for that additional money that they need to pay us? We debit our foreign debtor by another £100. So that is updated, and we credit our foreign exchange gain. So we have an income here as a result of the change in the exchange rate. Now we can receive the money where we debit bank and credit our foreign debtor with the full £400 on settlement date. When looking at example 8, this question tells us that a company in Botswana purchased inventory for £100 from a company in the UK on the 5th of March 20X1 being the transaction date. The purchase price was only paid later on the 5th of April 20X1, and the year end of the company in Botswana is 31st of March. So here we can see there's a slight variation from our previous examples where we now have our transaction date on the 5th of March. Then we have the year end on the 31st of March, and only thereafter we have the settlement date on the 5th of April 20X1. So we're going to see that the monetary item, so the foreign debtor or creditor, would be restated at year end of 31st of March, and it will also be restated on the 5th of April, the settlement date. Okay, so two pockets of exchange rates differences that are ultimately going to be recorded in our journal entries. The requirement is to prepare the journal entries in the books of the Botswana company. So what did the Botswana company do here? Botswana company purchased the inventory. So they've done some importing. They've purchased something. So they would be debiting their inventory and they would credit a foreign creditor. So that's what we expect to see on the very first day of our transaction date. We debit our inventory, we credit our foreign creditor with what value? We use our exchange rate and it equates to 300 pula. Now we've reached year end. So at year end, the rule in terms of foreign currency transactions is we must now update our foreign creditor for the change in the exchange rate itself. So any monetary item, such as your foreign creditor, now needs to be updated. If we update it, we find that now, if we were to settle our foreign creditor at year end, we would actually have to pay them 370 pula. Okay, but we initially recorded our foreign creditor at 300, so we need to account for that additional 70 as a result of the movement in exchange rate. So credit our foreign creditor with the additional 70 that we would have to pay, and debit our foreign exchange loss. And we then move on to our next important date as per our timeline, and that is the 5th of April 20X1, where we are now settling. And remember, we can't simply settle our foreign creditor. We firstly have to update using our new spot rate on settlement date, and thereafter we can provide for settlement. Okay, so restate our foreign creditor. How do we do that? We look and see, well, what would we in fact have to pay them if we paid them today? So using our exchange rate, we would have to pay them 400 pula. But we had at year end states in our foreign creditor at 370 pula. So there's an additional 30 pula that we need to pay. We will need to increase our foreign creditor by crediting them with that additional 30, and we debit our foreign exchange loss. Now foreign creditor is sitting at the correct value at settlement date of 400, and we can in fact pay them. Debit our foreign creditor, we no longer have that obligation, and credit bank. Looking at question 9 from your Gripping Guard textbook, this question tells us that a company in the UK sold inventory for 1,200 pula to a company in Botswana on the 17th of May 20x5 being the transaction date. The sale proceeds were received on the 13th of June 20x5. The cost of the inventory to the UK company was £150, and the UK company has a 31st of May financial year end. We're then given a table in terms of the relevant exchange rates for each of those important dates. So again, similar to our previous example, we've got firstly the transaction date being the 17th of May. Then we have the year end, the 31st of May. And then we have settlement date being the 13th of June. The requirement tells us to prepare the journal entries in the books of the UK. So the UK is the company that is in fact selling the inventory. So we expect to see our very first journal as credit sales debit our foreign debtor. And that's exactly what we found. On transaction date, we need to show the journal entry for the selling price of the inventory. How do we do that? We credit sales with 300, being the translation on transaction date. And do we debit bank or do we debit foreign debtor? Okay, we debit our foreign debtor because they're only going to pay in the future. We said whenever we have a sale of inventory, there's always two legs to the transaction. The second leg of the transaction reflecting the cost price of the inventory itself. So debit cost of sales, credit inventory with the cost price of the goods that were sold at £150. We then have our financial year end on the 31st of May. And what needs to happen at a financial year end is we need to translate or restate our monetary items. What monetary items do we have here? We have a foreign debtor. So foreign debtor needs to be updated. And we found that if we were to receive money from the debtor at year end, they would in fact pay us £353, but we only recorded them at £300. So we need to account for this additional £53 that they would have to pay us. So we debit our foreign debtor because they would have to pay us more by £53, and we credit our foreign exchange gain, that's an income in our statement of profit or loss, by £53. We then reach our next significant date being the settlement date on the 13th of June. And again, we need to update our foreign debtor before we in fact record the amount we're going to receive from them. And so end of June, we now need to update our foreign debtor. So now they're going to be settling us and they're actually going to be paying us £400. But at year end, we had updated them to reflect the value that they would pay us of £353. So that means there's an additional £47 that they would need to pay us. And how do we record that? By debiting the foreign debtor by £47 and crediting our foreign exchange gain. We now have updated our foreign debtor to reflect the correct value of £400 on settlement date. We now can record the receipt from our debtor where we debit bank with £400 and we credit our foreign debtor as they no longer owe us that money. We then move on to question 10 from our Gripping Guard textbook. I know there's a lot of examples, but they really do illustrate a number of important concepts and they are building on each other as you've seen. Okay, so looking at question 10, what do they tell us? It's that a company in the UK ordered inventory to the value of $900 from an American company on the 16th of Jan 20x1. The transaction date, however, is only the 5th of Feb 20x1. The year end is 31st of March 20x1, and the relevant exchange rates are as follows. So we're given the date that they ordered the inventory. We're given the transaction date, which is 5th of Feb. That's generally when we would start recording from, because that's when risks and rewards pass. We then have year end, 31st of March, and then finally that 5th of April would be our settlement date. So they tell us to prepare the journal entries in the books of the UK company, assuming they pay the American company on the 5th of April 2021. So being our settlement date. So we are doing this journal entries from the perspective of the UK company who purchased the inventory. So 16th of Jan 2021, are we going to have any journals? No. When is our first journal going to be? Only from transaction date, when risks and rewards transfer. So our very first date, we're actually going to be recording the purchase of that inventory will be on the 5th of Feb. And how would we record the purchase of inventory? We would simply debit our inventory and credit our foreign creditor. We take the $900 divided by 2.5 because that is the exchange rate on the 5th of Feb 20X1. And we then have our recording at 360. So debit inventory with 360 and credit our foreign creditor with 360. What is our next significant date? That would be our year end, which is the 31st of March 20X1. And at year end, we need to restate or update our monetary items. So our foreign creditor needs to be updated at year end. How do we do so? We need to see, well, what would we pay them if we in fact settled on year end? So if we were to settle at year end, we would actually have to pay them $400, but we've only recorded them at 360. So how are we going to update them? Yeah, we need to provide for an additional 40. So we need to up our foreign creditor by an additional 40, and our contra account would be debit the foreign exchange loss. Okay, so for the fact that we're going to have to pay more to our foreign creditor, it means that ultimately we are incurring an additional expense as a result. We then reach settlement date, being the 5th of April 20X1. And again, before we are actually settling that foreign creditor, we need to update and restate them with our new spot rate of £1 to $3. Okay, so at the 5th of April 20X1 settlement date, we now find that we had recorded our foreign creditor at 400, but now, in fact, at settlement date, it's worked out in our favor. We only have to pay them 300 and not 400 like we thought at year end. Yeah, because we have to pay them less, we're going to debit that foreign creditor by 100 and credit a foreign exchange gain and income of 100. Now we have updated our foreign creditor to the correct value of 300, and we can in fact settle them by debiting our foreign creditor with 300 and crediting bank with 300.